Hello, thank you for joining us today. Welcome to our webinar, Your Guide to UK Inheritance Tax. My name is Peter Webb and I'm Head of Tax Advisory for the Fry Group. So before we get started, there are just a couple of housekeeping points. The first is, please do use the Q&A button to ask any questions as we go through, and I'll try and answer as many of those as I can at the end of the presentation. And secondly, we will be happy to forward you on a copy of today's slides. So I'm really hoping you've got some great questions for me. I've actually got a couple of questions for you. So the first of the questions that I have for you is going to pop up on your screen now, and it's a multiple choice question. And the question is this: what is the current rate of UK inheritance tax? And you've got your choices there. So I'll just give you some moments just to answer that. Lots and lots of you are voting. Now the voting's slowing down a little bit, but I'll just give you an extra moment. Okay, I think we'll close the polling there and let's see how we did with that, if we can put the results up. Okay, all right. Wow, amazing. 93% of you went for 40%. 2% went for 36%. 20% was 6% of you went for that. Nobody said 0%. Well, this is my first apology of today. This was a bit of a trick question, because current rates of UK inheritance tax are 40% is the headline rate, but 36% is also a rate if you give a certain amount to charity. 20% is applied to some gifts you make into certain trusts, and 0% is a rate that can apply as well. So thank you for that. Okay, just what's that? There we are. Okay. Just needed to get rid of that. Thank you. So our agenda for today, let's get started. Please bear in mind you shouldn't take any action on the basis of this presentation alone without seeking specific advice for your own circumstances. I'd also mention I'm only talking about UK tax. Please do have regard to any other tax implications there may be anywhere else for you. So on this slide, you can see our agenda for today. We're going to talk about what is inheritance tax? How much inheritance tax will you pay? Importantly, steps you can take to reduce your inheritance tax bill. And finally, I'm going to try and answer as many of your questions for you as I can at the end. Oh, I think of inheritance tax as being the most punitive and pernicious weapon in HM Revenue's arsenal. Now, why am I saying that? Well, in many cases, it's a further tax on income and gains that have already been taxed throughout your lives. So some technical details on this. When is inheritance tax charged? So IHT, inheritance tax, is due 6 months from the end of the month of death or transfer into a trust, or the 30th of April in the following tax year, whichever of those is later. There are some circumstances where inheritance tax can be paid by instalments, and that can help. There is an inheritance tax return that may need to be completed, and if an inheritance tax return does need to be completed, that's due to be filed 12 months from the end of the month of death or transfer to a trust. If you're married or in a civil partnership and you leave all of your assets to your spouse, provided you share the same domicile status, and we'll mention that in a little bit, there is no inheritance tax charged when the first one of you passes away. It's when that second spouse dies and leaves your joint estate to your intended beneficiaries, so perhaps your children, for example, that's when the inheritance tax charge kicks in. And it's the executors of your estate, the administrators of your estate, who are generally responsible for calculating and paying any tax due to HM Revenue and Customs. But a word of caution, there can be occasions when the recipient of a gift made by you can be responsible for paying the tax themselves when you pass away. And we're going to specifically mention that later on. Finally, on this slide, I've told you when you need to pay the tax and who pays the tax. And we should also think about rates of tax that may apply. And this goes back to my trick question at the end. So these range from 0% for assets passed on within your available allowances or benefiting from some specific exemption. There's a 20% rate that is charged for what we call chargeable lifetime transfers. And these are gifts into some specific types of trusts, and that gift would be above your available exemption. And in that case, there can be an immediate 20% inheritance tax charge during your lifetime. We have a 36% rate if generally 10% of your estate is left to qualifying charities. And there's a lot of detail behind that calculation of that 10%. And then, of course, we get to our headline rate of 40%. So moving on, we want to think about how you can understand what your inheritance tax exposure is. How do you calculate how much tax you're going to pay? So your inheritance tax exposure is driven by a tax status that you have, and we call this your domicile status. Now, don't confuse domicile with residence. I see this very often. Your resident status is assessed each year under the really complicated statutory residence test, and it's not the same as your domicile status. Your domicile status is determined over the longer term, perhaps over the course of your lifetime. So why does it matter? What impact does this have? If you're a UK domiciled person, then your liability to UK inheritance tax extends to your worldwide assets. Everything you have anywhere in the world is within the scope of UK inheritance tax. But if you're not UK domiciled, it's quite different. The liability to UK inheritance tax for a non-UK domicile is limited to UK assets only, and the overseas assets of a non-UK domicile are outside of the scope of that 40% UK inheritance tax charge. So you understand that being non-UK domiciled carries a large advantage for you when it comes to inheritance tax. So how do you know if you're UK domiciled or not UK domiciled? That then becomes very, very important. If you were born in the UK of parents themselves who were born in the UK and you've always lived in the UK, it's very likely you're actually UK domiciled. If you were born overseas to parents themselves who were born overseas and you've never lived in the UK, it's very likely you're not UK domiciled. But if your circumstances fall anywhere between those two polar opposites, you're going to need to take some specific advice to determine what your UK domicile status is and what your exposure to UK inheritance tax is. One of the most common questions I'm asked is, can a UK domicile who's exposed to everything for inheritance tax become a non-UK domicile, so then it's only UK assets and all the overseas assets can escape that 40% inheritance tax charge? So the answer to that question is yes, a UK domicile can become a non-UK domicile, but it's a very hard thing to do. It's a very high bar test, and you definitely need specialist advice for that. And if that's your claim that you're not UK domiciled by choice, having a domicile of origin in the UK, but changing that to a non-UK domicile status, HM Revenue are going to scrutinise this in real detail. There are a couple of famous cases that we would always refer to. I think one of the most interesting famous domicile case involved a British financier called Sir Charles Claw. And this goes back to the early 1980s. Now, Sir Charles Claw had retired to Monaco, and that was where he claimed to have a domicile of choice. HM Revenue investigated this in great detail because there was a lot of tax at stake. It was clear from friends and acquaintances that Sir Charles was not happy in Monaco, and he spent much of his time in Paris. And he also mentioned to close friends that he longed to return to the UK. Now, on his death, when he passed away, HM Revenue went to the trouble of calling witnesses to court to testify that Sir Charles had not been happy in Monaco and he longed to return to the UK. And that desire to return to the UK was fatal to his claim to be non-UK domiciled, and HM Revenue and Customs were able to claim a 40% tax on his worldwide assets, everything that he had. If you have a moment, you want to use your favorite search engine to search for Sir Charles Claw, C-L-O-R-E. He's a fascinating character. He led a really, really interesting life. So, having talked about inheritance tax and the rates and how you're exposed to inheritance tax, I think I want to move on and think about how we can start reducing your exposure to inheritance tax, reducing your inheritance tax bill. So over the next few slides, what we're going to do is consider some of the simpler ways that you can reduce that 40% tax charge. Before we do that, what I want to do is ask you another question. And that second question is going to pop up for you on your screens now. So how many of you already have a plan in place to reduce your inheritance tax bill? Okay, I think that's settling down. I'll just give you a further moment. So goodness me, I think we're pretty much there. So I think we're going to end the poll there, and then we're going to share the results with you. Okay, so yes, 26% of you have a plan in place, 18% of you have a plan in progress, but scarily 56% of you have no plan in place at all for inheritance tax. So maybe this is the first step in your journey. Okay, so steps to reduce your inheritance tax bill. Strategies fall under 4 broad categories. So spend your money, spend your inheritance. So we call this skiing, spending your kids' inheritance. Simple but effective. I can't give you advice on how you should spend your money, but if you want advice in that area, then I'll introduce you to my wife. She is a leader in this field. Gifting, gifts in life to intended beneficiaries, gifting into trust. We're going to talk about those, and they're great ways to reduce your exposure to UK inheritance tax. You can also use insurance to fund a possible IHT bill as well. That can be part of your plan. And you would certainly want to speak to a financial planner about how insurance could help you reduce your exposure. And there are some investments that you can make, and those investments can be inheritance tax friendly, provided conditions are met. The value that you have in those investments can be excluded from UK inheritance tax. So I'm just going to think about 1 or 2 of those little bits and pieces around the investments. So there can be assets that qualify for what we call business relief. So that's going to be something like a qualifying trading business, or shares in an unlisted qualifying company, shares in an unlisted trading company, or shares in a qualifying company listed on the alternative investment market, AIM listed shares. So with these business relief investments that you make, after 2 years, you could find that the investment you've made is completely free of inheritance tax. Just a quick mention, business relief is not available to buy-to-let investors. It wouldn't help you with the property that you have that you're letting out. Another kind of investment that you can make that is inheritance tax friendly would be for what we call agricultural property. So this is agricultural property relief. And it's available on land which is occupied for the purposes of agriculture, together with appropriate buildings and farmhouses used in conjunction with the land. Now, the property must have been owned and occupied for those agricultural purposes immediately before its transfer, so immediately before you pass away, for 2 years, if it's actually occupied by you. But if it's not occupied by you, you need to own it for 7 years before you pass away in order to get that inheritance tax exemption. Another mention would be for pension pots. Now, this is really valuable. So the pension savings that you have, if it's a UK pension scheme, or if it's an overseas pension scheme that meets rules that what we call QROPs or QNUPs, there's a lot of detail there. But these qualifying pensions, the investments that you hold in those pensions, are outside of the scope of inheritance tax for you. And in addition, particularly with UK pensions, there can be further tax reliefs in terms of income tax for investing in the pension as well. That's certainly one to explore with your financial planner too. So gifts in life to other people. So making gifts to your intended beneficiaries, for example, your children, is, in my view, one of the simplest and most effective ways to reduce your inheritance tax bill. As long as you survive 7 years from making that gift, the value of the property or asset that you've gifted will not be charged to inheritance tax in your estate. If you survive for more than 3 years from making that gift, you're still winning, because the rate of inheritance tax on that gift then begins to taper down. And it tapers down from 3 to 7 years. And when you survive 7 years, there is no inheritance tax due. So that's the upside, but what are the downsides? And there are downsides. So you're gifting something away, and for this to be effective for inheritance tax, you cannot retain any benefit in the asset that you've gifted. You can't retain any benefit, and in addition, you lose control of that asset that you've gifted. And for making a gift of an asset, maybe there's a tax cost. Maybe you're going to be charged to capital gains tax because you've disposed of an asset, you've gifted it away. And the recipient of the gift generally is liable to pay the inheritance tax on that gift if you don't survive for 7 years. So upsides, it's very simple and effective. Downsides are there are conditions and you're losing control of that asset and you can't retain a benefit in it. An alternative might be to consider gifting into a trust instead of making a direct gift to your child. And that might be able to solve some of those downsides. And we'll talk about gifting into trust later on. So gifts in life to your spouse. So if you share the same domicile status as your spouse, any gifts between you made both actually in life and death are exempt from inheritance tax. So gifts between spouses who share the same domicile, there's no inheritance tax. However, if one of you is UK domiciled and you're passing assets to a spouse who is not UK domiciled, you do have an exemption for the funds that can pass to your non-domiciled spouse free of inheritance tax, and that limit is £325,000. Gifts above that, generally, you're going to need to survive 7 years for that to be effective for inheritance tax purposes. Plus, there are some conditions that need to be met. Now, when you pass away, if you're a UK domiciled spouse, you're leaving assets to a non-UK domiciled spouse, then you have a further exemption of £325,000 that can pass to your non-domiciled spouse without inheritance tax being charged. But above that, you're going to incur a 40% inheritance tax charge on your passing. So to avoid a non-domiciled spouse receiving those assets, £325,000 and 40% above that, to avoid that scenario, what your non-domiciled spouse can do is to elect to be UK domiciled. So we are now venturing into some really detailed inheritance tax planning. Please do speak to an appropriate advisor before taking any action in this respect. So your non-UK domiciled spouse can elect to be UK domiciled, and the effect of that election is that they can then receive all assets from you without paying any inheritance tax at all. So the upside of that is no inheritance tax is charged at that point. But that election, which is irrevocable, means that your non-UK domiciled spouse now holds maybe all of your assets, and they are UK domiciled, and all of those assets are then within the scope of UK inheritance tax because they're in the hands of somebody who has elected to be UK domiciled for inheritance tax. Now, that irrevocable election does lapse. It falls away once you've been non-UK tax resident for more than 4 UK tax years. In terms of timing, there is a 2-year window which the executors of your estate or perhaps your spouse can make this election with HM revenue following your passing. So there is a little bit of thinking time with this. I think this is one of the most helpful and useful inheritance tax reliefs. You're able to make gifts that are immediately exempt from inheritance tax without the need to survive 7 years. There are conditions that need to be met. The gifts must be genuinely made out of your income. So you can't be realizing capital, selling something to fund the gifting. They have to form part of your normal expenditure, and they have to be paid out on a regular basis. And those payments that you're making should not have any impact on your own standard of living. Why I like this exemption is that although it requires good record keeping and there are some conditions to be met, nobody's asking you to purchase some kind of financial product with an inheritance tax advantage. And it's very simple. You could set this up this afternoon or this evening if you wanted to. So as I said, one of the simplest ways to pay less inheritance tax is to make direct gifts to your intended beneficiaries during your lifetime. And that value of that gift then reduces your chargeable estate. However, we did mention some downsides. You lose control over that asset that's been gifted away. And you may have this tension between reducing the value of your estate and what is the right time, perhaps for your children, for example, to be gifted significant wealth. The alternative to making an outright gift, for example, to a child, is to make a gift into trust from which your child can benefit at the right time. There's detailed tax planning and advice needed, but this can be a way to retain control of assets. And you can do that even beyond the grave. There could be a letter of wishes, which would sit with the trustees, explaining types of life events which you would consider it appropriate for your children, for example, to receive distributions from the amounts that are held in that trust. And you could see, I've seen things like getting married as one of those examples, purchasing a house or starting their own business. So it's these kind of life events where the trustees would have your letter of wishes and they would use their discretion perhaps to benefit your children at those times. So to give another example, another way trust planning can be helpful is to protect assets for the next generation. I think it's easier to give an example of what I mean by this. So perhaps you're in your second marriage, but you're living in your family home and you want that family home to go to the children from your first marriage. And you're worried that if you predecease your second spouse, you're worried that they will remarry and your home will then pass out of the reach of your first family. So what you can do is, on your passing, you could leave your spouse what we call an interest in possession, a special kind of trust in your family home. And that family home could then be left to your children from your first marriage on that second spouse passing away. So what that allows is, it allows your second spouse to live in the family home during their lifetime and benefit from that, but with no risk that the family home will pass out of your first family, and with the assurance that your children will be left that family home when your spouse passes. And again, there's a bit of detailed advice to give around that. So the last trust I'm going to mention is what we call an excluded property trust. So generally, the overseas assets held by somebody who is not UK domiciled are excluded from UK inheritance tax, and we call those assets excluded property. Now, when a non-UK domicile becomes UK tax resident, the clock starts ticking on that really helpful non-UK domicile status. They'll become UK domiciled on the earlier of the dates that they are seen to have acquired a domicile of choice in the UK, or when they look back and over the last 20 tax years, they've been UK tax resident in 15 of them. At that point, the non-UK domicile becomes UK domicile for all taxes. And what that means is that overseas assets then come within the reach of that 40% UK inheritance tax charge. They were excluded before, but now they're within the charge. However, if that non-UK domicile were to settle excluded property, so gift excluded property, into a trust before they become UK domiciled, those overseas assets would remain excluded from UK inheritance tax, even past the point where they themselves have become UK domiciled. There is significant advice to give around that. I've just given you the headlines on that. Apologies, just had to use my cough button there. So there are other interesting types of trusts that you can use to help you with your plan to reduce your inheritance tax bill. And a financial planner will be able to guide you through the different types of trust that may be available to you. I've just mentioned 3. There are indeed many more. So we're now going to go on and think about the available inheritance tax allowances that you have. So what allowances are available? So I think as a minimum for inheritance tax planning, you should ensure that you're using your inheritance tax allowances each year, because they're available on a use it or lose it basis. You have an annual exemption for inheritance tax, £3,000. If you haven't used it in the previous year, your previous year's exemption is also available to you. So an amount that can be gifted, and you don't have to wait 7 years for that to be exempt from inheritance tax. You can only carry that allowance forward for 1 year. There's a small gift exemption, £250, for any number of gifts that you make in the year, but only if they're to different people. So you can't make £250 gifts to the same person and get that exemption. So allowances for gifts on marriage. So generally, the gifts need to be made, or at least promised, before that marriage civil partnership takes place. But don't miss the opportunity. These gifts are immediately exempt from inheritance tax without the need to survive for 7 years. And you'll see that perhaps parents, each of them can gift £5,000 to their child and £1,000 each to their daughter-in-law or son-in-law. So there's a significant amount that can be gifted that's going to be immediately exempt from inheritance tax on marriage. There is a nil rate band for inheritance tax, and that nil rate band is generally the amount that can be passed that is exempted from inheritance tax. We mentioned that if you share the same domicile as your spouse, and when you die, all assets pass to the surviving spouse, no inheritance tax is charged. But that nil rate band from the first spouse wouldn't have been used. So when the second spouse passes away, they can benefit from the unused nil rate band that their first spouse had. And that could exempt £650,000 from inheritance tax of the estate that's left to beneficiaries. In addition to the nil rate band, there is a residence nil rate band. So gifts to direct descendants can benefit from this additional residence nil rate band, and it's up to £175,000. But this additional residence nil rate band is only available for the value of a property which has at some point basically been your home. Now, if your death estate exceeds £2 million, for every £2 over that threshold, the additional nil rate band is reduced by £1. So when you combine the nil rate band and the residence nil rate band, it may be possible for a couple to shelter £1 million from inheritance tax using those nil rate bands. I'm moving on a little bit. I'm going to talk about wills. Now, wills can form a key part of your plan to reduce your inheritance tax bill. You've seen from the previous slides that who you leave your assets to is very significant for inheritance tax. And here I list some great reasons to have a will. It allows you to choose an executor, decide who gets what, name a guardian for your children. That could be really important. Make funeral requests, donations to charity. And those donations to charity can impact the rate of inheritance tax that you're going to pay. You can give personal items to your loved ones, leave your pets to someone, and it helps you to plan for inheritance tax as well. Now, what I would mention is that around about 20 years ago, I inherited a little tortoiseshell cat called Kitty from my great aunt. True story, lovely cat. What's always concerned me now that I know about these things is what would have happened if my great aunt hadn't left Kitty to me in her will? What would have happened to Kitty? It does not bear thinking about. So what happens if you don't have a will? If you don't have a will, don't make the assumption that your assets are going to be distributed to the people you intend to benefit from your wealth. Without a will, your assets pass under the rules of intestacy, and the rules of intestacy are complex. To give one example, a family with children. If there is no will, the children will be entitled to receive assets from your estate. And that could lead to an unexpected inheritance tax bill, because it's the transfers to your spouse that can be exempted from inheritance tax. Transfers to your children when you pass away are chargeable. And if those transfers are above your nil rate band, there is an inheritance tax charge. What about if you're not married or you're not married or in a civil partnership when you pass? And what happens then if you don't have a will? Well, under the rules of intestacy, your partner will not be entitled to receive any of your assets. So some more complexity, wills for non-UK tax residents. This is really tricky and it's going to depend on your personal circumstances. I'm going to make some very general comments on this slide, but you should take very specific advice if that's you. You've got assets in different countries and you need wills in different countries. The laws governing estates in both your home country, your country of residence, and countries where you have property need to be considered. Each country has their own laws to govern the distribution and taxation of an estate. And if you own assets in more than one country, you may require several wills. It's really important that these wills work alongside each other, and they need to be written really carefully so that perhaps a will written subsequently in a different country doesn't revoke a will already made somewhere else. So for example, perhaps you suddenly purchase a property in Portugal. You may want to have a will for that to govern the distribution of that property in Portugal that's written under Portuguese law. But what does that mean for all of the other wills that you actually have? Extreme care is needed. Please do speak to the professionals. Okay, wrapping up. Thank you for bearing with me so far. If you're struggling, we're almost there. We're almost at the point where we're going to move on and see if I can answer some of those really interesting questions that you've been asking me. So on this slide, I include my key takeaways for today. The starting point for inheritance tax planning is to understand what your inheritance tax exposure is. What is your liability? I think one of the key things is to consider when is the right time to pass wealth to the next generation or your intended beneficiaries, because that can be one of the simple ways to plan for inheritance tax. Each year, use your available allowances and make sure you have the right wills written to help with that inheritance tax plan. I think what I would say finally on this is don't assume that you don't have an inheritance tax problem. Speak to an advisor to find out. And if you do have an exposure to inheritance tax, there may be some really, really simple things you can do to save that 40% inheritance tax charge. Okay. So now what we're going to do is look at some of those really interesting questions that you've been asking me. Okay, first question, anonymous. Are you entitled to the 325,000 nil rate band, even if you've not made a will? Is it automatic that it can be used? Yes. You don't need to have a will to have that nil rate band. It is available to you. So yes, I think it's a really simple answer. Next question, again, anonymous. What specific measures should a non-dom take before returning to the UK to reside permanently to mitigate or avoid IHT? Yeah, that's a great question, actually. You're going to need to come up with a plan that is specific to you, to your aspirations, to consider how much funding you're going to need in your retirement. But I think one of the things to do is to consider whether or not it's going to be sensible to settle some assets, overseas assets, excluded property, into that special excluded property trust. And if you are going to do that, you also want to consider who's going to be able to benefit from that trust as well. You need to understand the date that you're going to become UK tax resident. Under the complex statutory residence test, it's entirely possible to become UK tax resident, perhaps even a few months before you actually return to the UK. I think what you need to do is to sit down with a professional, look through your specific circumstances, and that professional will then be able to make that plan for you. So another anonymous question, where invested financial assets are held in individual names by a married couple, while all other assets are held jointly, what is the IHT position when one spouse dies? The starting point for this is what is the domicile status? So if you assume that you share the same domicile status, then I think looking at those jointly held assets first, those jointly held assets would pass by right of survivorship to the surviving spouse. And if you share the same domicile, then there's no inheritance tax paid. For the assets that are held individually, the inheritance tax exposure on that is going to be determined by who you leave them to. So if the individual assets are left to the surviving spouse and you share the same domicile, no inheritance tax. But if there's any other destination for those individually held assets, then you need to understand what the inheritance tax would be. And again, a professional could help you do that. Another question, this one's a little bit longer, but it's a great question. So if a second property is sold, capital gains paid on it, and the net amount paid into your bank account, what happens if you should then unexpectedly die within a short period of that occurrence? The money, along with the value of all other worldwide assets, would all be subject to inheritance tax, thereby running the risk of creating a double tax situation, that is being taxed twice on the capital gain and then again on inheritance tax. And that is a great point to make. And it goes back to the beginning. This is why inheritance tax is such a pernicious thing, because you do have tax that you've paid on your funds during your life. And if those funds are in your estate, you get the double whammy of inheritance tax as well. So Brian's asked a question. Husband and wife are domiciled in different countries. What difference does that make, if any? Can I still pass my assets to my wife who is not UK domiciled in the UK tax-free? So we did have some specific comments on this on the slide. So very brief summary. If you're a UK domicile and you're passing assets to a non-UK domicile, there could be an inheritance tax charge. You get a lifetime allowance of £325,000 and a death allowance of £325,000. Above that, there is the possibility of inheritance tax being charged on passing assets from a UK domicile to a non-UK domicile spouse. We talked through that domicile election, which may help, but I think it would be a good idea, again, a lot of this, you need to sit down with somebody to talk you through this. So Graham, hello Graham, a UK domicile living in Belgium with no intention to return to the UK. Will my assets in Belgium be subject to both Belgium and UK IHT, any double taxation relief? Even if you're a long-term non-UK tax resident, it may be the case that you haven't shaken off that UK domicile status. And if so, your worldwide assets are within the scope of UK inheritance tax. And if you are also charged to Belgium inheritance tax, actually, I'm not sure that we have a double taxation agreement between the UK and Belgium. So there could be some relief for the tax you pay in Belgium for inheritance tax, or your estate pays. Yeah, you'd want to look at that very, very carefully. Is it possible that you've lost that UK domicile status? You need to understand what the Belgian tax would be. That's not something that we would advise on. We only look at the UK tax for you. Nigel's asked a question, very simple question. Do UK savings inside an ISA fall inside the scope of inheritance tax? Yes, they do. What you would, I think the only way out of that would be if you were not UK domiciled and you held collective investment funds in that ISA. But failing that, I expect that's probably not the case. ISAs are great, they're free of income tax, they're free of capital gains tax, but they certainly are within your inheritance tax estate. I just mentioned very briefly that one of the things I like about ISAs is that you can gift the assets in an ISA to the next generation, and there's no inheritance, sorry, I beg your pardon, no capital gains tax to pay. Making direct gifts to your intended beneficiaries during your lifetime is a great way to reduce your exposure to inheritance tax But generally, if you're a UK resident, and even if you're giving UK property and you're not UK resident, there's likely to be a UK capital gains tax charge. ISAs are one of the few investments that you can hold where you can gift it without that capital gains tax charge. Okay, there's a specific question here from Stuart. Can parents gift their home and only property to the children, still live in it and pay the children rent? Is this a well-trodden and guaranteed route to save inheritance tax, subject to the 7-year rule? Does this scheme have a name? I'm not sure the scheme actually has a name. It is possible to do this. There are some very large caveats that you need to consider. So you do need to pay your children a market rent, regularly reviewed, to make absolutely sure you're not retaining a benefit in the property that you've gifted. Another consideration here is that you are going to lose control of that property. You don't own that property anymore, your children do. And there can be some quite unexpected consequences for that. So do bear that in mind. And also the rent paid to your children, that's taxable income in their hands, and they'll have to pay tax on that and pay that over to HM Revenue and Customs. And if they don't prepare tax returns already, they will then need to prepare tax returns. I wouldn't take any action on this until you've actually spoken to somebody. It's a possible strategy, but there are some serious health warnings that go with that. Okay, anonymous, can you gift to a nephew if you have no children? Absolutely you can. So again, the same rules apply, that it might be that potentially exempt transfer where you need to survive for perhaps 7 years before that's outside of your estate, provided you don't obtain any benefit on it. But perhaps you want to use an exemption such as the annual exemption that's available, or even indeed make a regular gift out of your spare income, using those rules to make gifts too. Okay, so Core has actually asked a question. Please confirm that a UK furnished holiday home with restricted owner usage is exempt from IHT if one's children continue to run it as such on our passing. I think I understand the intent behind this question, and it's a vexatious question for HM Revenue and Customs. There is a specific regime for furnished holiday letting, which has many tax advantages. And it's where you're letting out a property in the UK or in Europe, and it meets some conditions that you're only letting it for the short term. Now, generally, furnished holiday lets are not exempt from inheritance tax under the business relief rules, which I think Core is what you're getting at. However, if you have something that's more like a hotel, you may be able to get that exemption, but you're going to need to look at that very, very carefully. So I think that the answer is generally, your furnished holiday letting is going to be within the charge to UK inheritance tax. So Graham's asked a question. Hello, Peter. Did you say that overseas assets of a non-UK dom are excluded from UK inheritance tax? I absolutely said that. Yes, that's absolutely right. And that then becomes a really compelling route to explore when you think about reducing a family's exposure to inheritance tax, if perhaps you have a spouse who is non-UK domiciled. I'm trying to find a question, perhaps our last question. So I want to pick something that we haven't really touched on. Okay. Let's pick this one. Could you explain domiciles of choice and how they are established? I'm going to pick this one because domicile is so fundamental to your exposure to UK inheritance tax. So I'm going to talk very generally, and you do need to take really specific advice for this. But perhaps you have a UK domicile of origin. and you want to establish a non-UK domicile of choice. Perhaps you're going to, I'm just going to pick Singapore, maybe Thailand. Thailand's nicer, isn't it? Thailand, we're going to go for Thailand. So you want to establish a domicile of choice in Thailand. So what you're going to need to do is you're going to become non-UK tax resident, and you're going to make it absolutely clear that you're never going to be UK tax resident again, and actually you no longer have any affection for the UK. So you're going to sell up everything that you have in the UK. Your visits to the UK are going to be nil or minimal going forwards. So you leave the UK behind you. You make it absolutely clear that you're never going to live in the UK again. That's one part of the strategy. The other part of the strategy is that you settle in Thailand and you make it absolutely clear that Thailand is now your permanent home. It is your forever home. It's where you have your family home and you're not going to live anywhere else. So it's a really, really high bar test. There is much good advice to give you around that. Well, thank you for your great questions. I'm really sorry if we didn't get to answer your specific question, but perhaps we can follow up with you for that. I actually realised looking at the number of questions, it's actually hit the 52 mark, so there are plenty of good questions. I know some of you are familiar with the Fry Group, but for those of you who don't know us so well, I just wanted to give a very short introduction. The Fry Group was established more than 120 years ago, and since then we've helped thousands of people around the world and across the generations. You see on the map there that we've actually got 8 offices around the world, and we can offer a global perspective. Our services cover 3 core areas of financial planning: tax, which is where I sit and gets the first mention, estates and investments. And our teams work together across these 3 areas and across countries to create the right balance for each client. Our core purpose is to help people achieve financial freedom. We understand that's going to mean different things to different people, so we take time to find out what is important to you so we can structure your finances around your goals. So on this slide, I'm including our contact details for you. And that just leaves me to say a really big thank you for joining us today. And thank you for your great questions too. Now, what's going to happen at the end of the webinar is you're going to get a little survey that pops up. And if you can take a moment just to complete that survey for us, that'd be absolutely great. We love to have your feedback and you have a chance to perhaps give us a few ideas for what else you would like us to be presenting on. So just leaves me to say thank you again. And thank you for your time today.